Hi everybody. In 1994, a banker from Citibank left a comfortable job in Malaysia and returned to India to build a bank from scratch. He had no branches, no customers and no loan book. He had only one idea: combine the products and service quality of foreign banks with the scale, reach and trust of Indian public sector banks. Over the next 26 years, that idea created one of the India's finest banking franchise. HDFC Bank compounded shareholders' wealth at roughly 25% annually for more than 2 decades and became one of the most respectable financial institutions in the country. Then in 2022, the bank made one major corporate decision, and over the next 3 years, its stock underperformed most major private bank competitors. The question is, how did one of the best retail bank franchise in the emerging world created a problem for itself? Was this simply an external shock, or was it a case of management choosing growth at a cost of structural strength? And what are the lessons that we investors can take from this episode? HDFC Bank was incorporated in 1994 as one of the first private bank in India licensed by RBI after India's financial sector was liberalized. It was run with one idea, which was the combination of product and service quality of foreign banks with the scale, reach and trust of Indian public sector banks. But before we talk about what HDFC Bank built, we need to understand how a bank makes money. A bank has two sides to its business. The first side is lending, that is giving out loans and earning interest on them. The second side is, which is far more important, is borrowing, that is collecting deposits from customers and paying interest in return. The difference between what the bank earns on its loans and what it pays on its deposits is called net interest margin. The wider the margin is, the more profitable the bank is. So, the critical point is that the profitability of a bank not only depends on how well they are lending, but also depends on how cheaper they are borrowing. And the cheapest source of funds for any bank is current accounts and savings accounts, which together are called CASA deposits. Current account holders keep money in their accounts to run their businesses. The interest the bank pays to them is 0%. Savings account holders keep their salary and household money in their accounts. The bank pays them around 2.5 to 3% of interest per year. Both of these are enormously cheap sources of money compared to fixed deposits, where the bank must pay 6 to 7% of interest per year. So a bank with high CASA ratio, where a large share of total deposits is in current and savings accounts, has structurally lower funding cost than a bank that relies on fixed deposits and other borrowings from the market. And lower funding cost sustained over long term produces wider margins, higher profitability and ultimately more shareholder wealth. This is the single most important concept to understand about HDFC Bank. It has built its CASA franchise slowly and carefully. Over 25 years, the result was a CASA ratio of 40 to 44%. This means for every 100 rupee of deposit HDFC Bank held, rupees 40 to 44 came from current and savings accounts at very low cost. The rest came from fixed deposits at market rates. No Indian bank of comparable size maintained a CASA ratio this high for so long. This structural advantage produced net interest margin consistently above 4%, whereas that of competitors was at 3 to 3.5%. That difference of 50 to 100 basis points compounded over 3 decades of balance sheet growth created an incredible wealth for its shareholders. The IPO of HDFC Bank in March 1995, which was priced at 10 rupees per share, provided a CAGR of 25% by 2020 without dividends reinvested. Then on 4th April 2022, HDFC Bank announced a merger of HDFC Limited with itself. On the surface, this sounded like a combination of two high-quality financial institutions, but economically, the two businesses were very different. HDFC Limited is fundamentally a different company from HDFC Bank. HDFC Limited is a housing finance company that borrows money from the wholesale market, that is from banks, bond market and institutional investors at around 6 to 7% per year. It then lends money to home buyers at around 8 to 9% per year. So, net interest margin of HDFC Limited is 1.5 to 2%. The logic of merger of both the entities was compelling. HDFC Limited's mortgage customers could now be cross-sold banking products. HDFC Bank could offer home loan directly, and the combined distribution would reach far more customers. So the narrative was attractive, but when we move from the narrative to the arithmetic, three problems would become visible. First, though HDFC Limited was bringing massive loan books at 8 to 9% yields, it was also bringing its own funding, which is more expensive than that of HDFC Bank. So the net interest margin of the combined entity would come down. A decrease in net interest margin means the profitability of HDFC Bank after the merger would be lower than that of the before the merger. Second, since HDFC Limited has no CASA franchise, the merger would bring the CASA ratio downward. Data shows the moment the merger happened, CASA ratio, which previously had been 44%, fell to approximately 38%. So 6 percentage points of cheap advantage built over 25 years evaporated overnight. And third, HDFC Limited brought huge loan book with it, but it didn't bring low cost deposits. So the loan to deposit ratio of the bank increased from 86% pre-merger to 110% post-merger. Ideally, a bank wants a large part of its loan to be funded by stable deposits. Now with loan to deposit ratio increased to 110%, bank must work hard and often pay more to fund the balance sheet. This tends to create margin pressure, and that is where the stock market reaction becomes easier to understand. Before the merger, HDFC Bank was seen as a simple, predictable compounding machine, but after the merger, the story became more complex. The bank was still strong, but the economics became less straightforward and the timeline for normalization became less certain. Markets usually pay premium valuation for simplicity, predictability, and consistency. When those qualities weaken, even a very good business can see its stock underperform. And that is the reason behind the underperformance of HDFC Bank for the last 3 years. This brings me to the 3 key lessons that we can learn from this case study. Lesson number 1. In banking, the real moat is not the loan book, it is the borrowing side of the bank. HDFC Bank's superior profitability was not driven by making better loans than competitors, it was driven by borrowing cheaper than competitors. The CASA franchise was the structural advantage. With the merger, that advantage got compressed. So the first lesson for the investor is not to look at the gross NPA, but to look at where does the bank get its money from and how cheaply. Lesson number 2, the compression of net interest margin was not a surprise to those who built a pro forma model using the published annual reports before the merger closed. The calculation didn't require any insider information or proprietary data or any special skill. So the lesson is, don't just rely on the narrative that the management is giving, start with the arithmetic and build the pro forma sheet yourself. And lesson number 3, the most dangerous moment to own a universally celebrated stock is when the market had priced it to be in continued perfection. This leaves no margin of safety. HDFC Bank had uninterrupted growth for more than 25 years. It survived 2008 global crisis, demonetization and COVID without a single year of profit decline. But when the merger produced net interest margin compression and CASA dilution, the market derated the stock. So the lesson is, when the quality stock is celebrated long enough, the entry price matters. A great business at a wrong price is not a great investment. HDFC Bank was something extraordinary. 25% CAGR for 26 years. A retail deposit franchise that no competitor had been able to replicate. A bank that had never had a bad year across 3 major economic disruptions. But one decision narrowed the structural advantage that bank used to have. The branches are still full, the customers are still depositing money, but what had changed is the simplicity of the story. And that brings me to the end of this video. And I hope this video was valuable to you. If this video was valuable, please like this video and subscribe to this channel for more such investment case studies. Thank you so much for watching. I will see you in the next one.